This video will walk you through the concepts presented in Chapter 12 and help you better understand them through the use of conceptual questions. Chapter 12 discusses the different types of business decisions, which are keeping or dropping a segment, make or buy, special orders, constrained resources, joint products, which are also called split off or process further, and finally retain or replace equipment. Question 1. Future costs that do not differ among the alternatives are not relevant. So the whole thing about incremental or differential analysis. Incremental means the difference or the change. So that is exactly what incremental analysis is looking at, is that we're looking to see what is the difference between the future costs among alternative A and B. So this is true. 2. Fixed costs are irrelevant in a decision. Well, when you think about fixed costs, this chapter shows you how you can further analyze fixed cost into what we call traceable or common. The traceable fixed cost is linked to the product or the department that you're thinking about dropping. Common costs are allocated to all the products using revenue. So if you get rid of a product, the traceable cost will be eliminated, but the common cost will remain and will have to be distributed to the remaining products. So therefore this answer is false, since common costs will be different for alternative A or alternative B. 3. Sunk costs are considered to be avoidable costs, and this is false. Sunk costs are what we call unavoidable. And this is because the expense has already occurred. Number 4. Avoidable costs are also called relevant costs, and that's true. Avoidable is relevant versus unavoidable equals irrelevant. So 4 is true. 5. Avoidable cost is a cost that can be eliminated in whole or in part as a result of choosing one alternative over another. And that is true, just as we said. So again, avoidable cost is where if you choose alternative B, that cost is eliminated. For example, if I choose to purchase my product versus making it, my variable cost will be eliminated and therefore avoidable if I purchase it. 6. A sunk cost is a cost that has already been incurred and that cannot be avoided regardless of what action is chosen. And this is true. Question 7. The book value of a machine as shown in the balance sheet is relevant in the decision concerning the replacement of that machine by another machine. And that is false, and let me explain why. When we talk about book value equals the cost less accumulated depreciation. So the book value is calculated every period of time. So every month, every quarter, we're going to calculate a new book value. Salvage value represents money that you will receive once you dispose of the piece of equipment. So book value and salvage value, very different. Now sometimes if a person says their salvage value is going to be equal to the book value at such and such a date, well then it's going to be relevant. But if you just talk about book value as it's seen on the balance sheet, which is just the cost minus whatever cumulative depreciation we've taken so far, it is sunk costs because the cost was when we purchased the piece of equipment, and therefore it is not relevant to any future decision about purchasing a new piece of equipment. The other thing to think about is depreciation expense is a non-cash transaction, but it reduces your net income. If we decide to dispose of our piece of equipment and get no salvage value, and let's say we have 3 years left of depreciation expense, instead of the depreciation expense reducing net income over 3 years, we would have a loss by disposal because the entire book value would be a loss. And it would still reduce the net income, but it would reduce it all in 1 year. So at the end of 3 years, whether we take it and reduce net income by depreciation over 3 years or reduce net income once we dispose of the piece of equipment and get the loss immediately, the end result is net income is still going to be reduced by the same amount. So it's sunk costs, and therefore it's irrelevant. So this one is asking that it's relevant, which is why it's false. Number 8, if by dropping a product, a firm can avoid more in fixed costs than it loses in contribution margin, then the firm is better off economically if the product is dropped. What this is saying is when you look at your sales less your variable cost, which equals your contribution margin dollars, let's say that's equal to 10,000. And we have fixed costs, though, that's equal to 15,000. Well, that's going to leave us a net operating income of 5,000. So, if we can avoid more in fixed cost, so if all this fixed cost is traceable to our product, and yes, we will lose the contribution margin, which means our net income would be reduced by 10,000, but we would lose the fixed cost, which means it would increase future net income by 15,000. We would actually, instead of having a net operating loss, the company would actually have a gain of 5,000. So, as long as your fixed cost saved is greater than the lost contribution margin, you should drop your product, which is what this is saying. So therefore it's true. 9. Depreciation expense on existing factory equipment is generally relevant to a decision of whether to accept or reject a special offer from a company. And just like we talked about above, depreciation expense is unavoidable and therefore irrelevant because it's also sunk costs. So the answer to this one is false. It's not relevant. Number 10. When a company has a product constraint, the product with the highest contribution margin per unit of the constrained resource should be given the highest priority. And this is true. What this is saying is when you've gotten down to your contribution margin per dollars, if you have no resource constraints, you would always choose the product that gives you the highest contribution margin dollars. But if you're limited, let's say, by pounds of a direct material that you need to buy to produce, you would take the pounds, and let's say it takes 2 pounds per unit. Now you calculate a contribution margin per pound. And the one that has the highest contribution per pound is the one you're going to build. And that's what number 10 is saying, so it's true. Joint costs are not relevant to the decision to sell a product at the split-off point or to process the product further. And this is sort of tricky, but it has here or, which means it's got to be true for both of these. And what we're talking about here is we have what's called joint cost. And the joint cost is processing raw materials and the same raw materials. And once it's processed, two products come out of it. Product A and product B. The joint cost is relevant to A and B because we experience a joint cost to produce A and B. And we can sell it A and B for a certain revenue at this point. But we can also process further for additional cost. But we want to compare that to the additional revenue that we could earn from processing it. And once we get to here, we have two new products, A plus and let's say B plus. The only thing that's relevant once we're talking about the process further is the additional cost and the additional revenue, and whether the additional revenue is greater than the additional cost. So joint cost is irrelevant when you're talking about should I process further. Which is why this is false. Question 12. Costs which are always relevant in decision making are those which are A. Variable. The problem is not all variable cost is always going to be relevant. B. Avoidable. All avoidable costs are relevant, so that looks good. Sunk are irrelevant. And fixed is rarely. Variable, I would say, is almost always. But the one that always is avoidable. A general rule in relevant cost analysis is A. Variable costs are always relevant. Well, we already just said not always. Fixed costs are always irrelevant, most of the time, but not always. Differential future cost and revenues are always relevant. Well, that's the whole thing about our business decision model here, so that looks good. And depreciation is always irrelevant and not for new equipment. So C is the correct answer. Number 14. The opportunity cost of making a component part in a factory with no excess capacity is the... Now what you want to understand here is when we talk about the opportunity cost, that is when we're talking about here a make or buy decision. And normally what you're looking at under make is what is relevant is your direct materials to make it, the direct labor, the variable overhead. So this cost is almost always going to be relevant. The purchase price is what's relevant under the buy part here. And the key is, if there is no excess capacity when you're making something, you are not going to take on